Well, good afternoon, everyone, and welcome to today's Lunch and Learn Bite-Sized Mortgage Strategies. I'm Kirsty Healey, and you've got me for half an hour today. So, interest rates have dropped, and yet a lot of us are just not feeling richer. Why is that? Your mortgage is one of the bigger drains on your cash flow. For most of my clients, that can be up to 40% of their income. You'll see in some of the slides that I'm going to show you today, sometimes up to 50% for some clients. That's all going to your mortgage and accommodation costs. Those accommodation costs have also increased a lot, like insurance and rates. Those everyday costs that come out of our account every month without fail. Add your grocery shopping on top of that, which how expensive is food these days, and the cost of childcare in order for you to be able to go to work and earn. All of these regular and mostly fixed costs are really crushing our discretionary budget, which is the one that contains our fund money. Whilst in the past, I usually see more of an 80-20 split between that fixed and discretionary costs. These days, what I'm seeing with my clients is that it's more like 85% fixed, 15% discretionary, or sometimes even a 90-10 split. So it actually does feel harder because most of our money is really that fixed cost that's going towards running the household. So today we're going to go through some tips and tricks and hacks on how to get your money working harder in your mortgage and how repaying your mortgage earlier can be the cornerstone of creating wealth. I want you to take a minute and imagine the liberty of not having a monthly mortgage repayment. What would you do? Where would you be? And how could you leverage that freedom? So, what we're going to go through today in terms of an agenda are what are the mortgage realities in New Zealand as they are today, because that has actually changed quite substantially since pre COVID, within the last 5 years. Why your interest rate and negotiating your interest rate is not the be all and end all of your mortgage strategy, and what we can do in terms of getting rate mortgage repayment structures in place that are going to get you ahead much sooner whilst using your existing resources. And also how paying down your mortgage unlocks equity, which in turn gives you choices that you can then lean on, whatever that might look like for you. Hopefully, we're also going to have some time to do some Q&A at the end as well. So, in terms of me, who am I? I'm a financial advisor and strategist here at Enable Me. I've got lots of experience in both banking and lending. I've had over 25 years in financial advisory services. I've also been a property investor for over 20 years and a property developer for part of that time, doing mainly hobby infill type development. I also run a business, and in terms of my educational background, I've got a bachelor's degree in economics. Don't hold that against me. So, essentially, what I do with my clients is really to optimize their outcomes strategically. So, how do we get you ahead sooner? How can we improve on your trajectory? Um, and if you're not quite in line for those goals, how do we course correct around that? So, just a bit of a disclaimer. I don't know you and your unique situation. I'd really love to, however. But if you'd like specific advice on your financial situation, we're going to have a special offer at the end of today's presentation. So hang around. But all the information that we're going to talk about today is going to be general in nature. So, why do we want financial security? Basically, it all comes down to choices, right? We all want choices to live the life that we desire. We want stability. As humans, we typically don't like uncertainty. And also, we want to support ourselves and our family and, our loved ones without having dependence on the system. We want to be able to, when things go a bit awry through unstable economic times, we want the ability to be able to ride through them. We control our controllables, but we also prepare ourselves for life's curveballs. And what that means is really just having that buffer to be able to ride through the storms, whatever they may be. We want the ability to also do the things that we want to do, because if we can't do that, what's the point, right? We want a life whereby we're following our passions, we are doing the hobbies that we want to do, and we want to protect those non-negotiables within our plan. But we also want to be able to get everything else working productively. And then we also want peace of mind. We don't want to be up at night worrying. And I think that is probably one of my leading important things that I want to concentrate on today, is that we don't want stress. We want to take that away from us, and we want to have a plan that actually puts ourselves back in the driver's seat with our money. And then independence. As I said before, one of my biggest drivers is being less reliant on the system. That includes the government, that includes being reliant on our pay packet and living week to week. We want to know that we've got a little bit of freedom and liberty. So, what is the current reality in terms of mortgages in New Zealand? When I said before that a lot of my clients have about 40% of their income going to their mortgage, actually, the statistic is about 49% of most New Zealanders' income is going towards their mortgage. And also attached to that is the stress piece. 59% of Kiwi mortgage holders are experiencing mortgage stress. And part of that is that the average home mortgage has increased from 300,000 to 550,000 within the last 10 years. If you're paying down your mortgage over a 30-year term, you're effectively paying back your mortgage 2 times over. And I'll be able to take you through some examples of that later on. So, building equity within your home sooner and paying down sooner is absolutely going to get you ahead of what is the vast majority of New Zealanders. And if we can free up that cash flow, we can really start thinking about those larger goals. So, look, New Zealand media. There are so many headlines out there. Personally, I don't find media headlines here particularly uplifting or inspiring. However, this morning I was listening to News Talk ZB. Yes, I listen to that every morning, to Peter Beck, speaking this morning on the success of his company, Rocket Lab, which is 20 years old this year. It has a market cap of 31 billion US. So I think that would claim that as a New Zealand success story. One comment that really stuck with me was that when he stands up in a room in the States and says, I'm going to build the biggest space company in the world, people cheer. In New Zealand, if he were to say that, people kind of go, oh, I don't know about that. I mention that because these headlines are just noise. And quite often they can be excuses on why you can't get ahead or take a small action, because that small action is so inconsequential. So don't let the headlines deflect you from your own personal plan. Yes, we've seen some light at the end of the tunnel by interest rates coming off. Yes, food is a little bit more expensive, and so are rates and insurance. But what does your personal plan look like? And what can you do regardless of what's out there? Because we can only control the controllables, right? We certainly don't have any impact on what's happening with the official cash rate next month. There's hope, and that's why you're in this webinar, right? Because you want to know how you can repay your mortgage faster. And quite often, the noise can intercept and cause money stress for you. Um, and quite often, we don't know our own capability. As an example, I'm working with a client who lost her hubby a year ago. She had never dealt with money. She didn't know any of her expenses. She had no idea about how mortgages worked. And in the span of something like 6 weeks, she is now firmly in the driver's seat, paying down our mortgage effectively, a really great mortgage structure, which has cut her repayments in half. So my message here is stay informed, take note from the headlines, but don't let it trigger your stress response. And if things are really overwhelming, ask for help. And inaction does cost you more than you think. There's always an opportunity cost to doing nothing, because doing nothing is also a decision in its own right. So, how do you know when the right time is to start? Because you can be making progress right now. As they say, the best time to plant a tree was 20 years ago. Next best time is today. Definitely don't think you should wait until interest rates are optimal, because we know from our experience that actually it's a really great mortgage structure that gets you ahead sooner in terms of paying down your mortgage. And whilst we're at the moment sitting in a period where there is limitless access to content, we think that we have all the information to get ourselves ahead, but quite often that can be quite overwhelming in terms of turning that into action points for ourselves in terms of which direction we should go in. So, yes, I say don't wait in terms of making a plan and taking some actions. However, do it on the basis of the right information. And sometimes that means listening to the right people and discerning what's best for your personal situation, because quite often that content out there is very general in nature. And that one example I had on this is I was talking to a couple I met with this morning who are in their 30s. They had never saved a dime in their lives. They joined us on one of our 12-month programs. Um, Within the first year, they'd saved for a big overseas trip, and they're now into their second year. They're now saving for their wedding, and we're about to do a consolidation, halve the interest on some of their personal debt, and get stuck into also planning how we reduce their mortgage. So the key is that you really just don't know what you're capable of, and sometimes it takes that third party to be able to highlight that. So you've got a starting point to work from. But look, it's not all about timing. Interest rate drops. It's not about the next headline that comes out. It's all around focusing on what you can control, what's within your own remit. And is there anyone out there in my audience that has a say on the official cash rate? If you do, can I be your friend? Most of us don't have a say on where interest rates are going or how fast the economy grows, what the tax rates are, or whatever the latest headline inflation number is. And look, I'm not immune to making mistakes myself. I've made plenty of them. Thinking about my last development actually and how that went absolutely um, opposite to the way I thought it was going to go, which ended up, you know, essentially me landing on Plan B. So whilst you can't plan everything to the T, having the backup, having a plan B to go to is really important. So, what I'd say is here to remember probably four things. One, what are your goals? Two, draft a plan. Three, roll out the plan that you've drafted. And four, have a plan B and a buffer. So, what are we talking about here with your controllables? You know, you cut through the noise, you focus on you. Doesn't matter so much what's happened already. We're interested in what your position is today, and we're all unique in terms of our starting point. So let's start from there and what are our goals and where we're heading to in terms of trajectory. What's the problem that we're trying to solve for? I.e., are we trying to pay off our mortgage sooner? And what's the time horizon that we have? For example, if you're saving for a wedding in 2 years' time, um, putting your money into an aggressive managed fund is not going to be the best solution for that. However, using those funds to also cut down the interest that you're paying on your mortgage might be a better idea. We also want to look at three things here, regardless of any economic environment. We want to optimize your spending, crush your mortgage, and create leverage. And what does optimize your spending mean? Because instantly, when I talk to my clients around this, they think about a budget, because it's not necessarily about spending less. It's actually being more aware of where your money is going and understanding what's really important to you. Have you tracked your money? Because quite often I have clients who have had insurance payments on a car they sold a year ago that are still running. So actually tracking can pull up some of those inefficiencies that we might have sitting within our cash flow. And es- essentially, crushing our mortgage is going to give us again those abilities to create leverage. And it doesn't necessarily mean actually just leverage. It means choice. It gives you choice to do the leverage part. It gives you choice to upsize your home. It gives you choice also to help your kids. And perhaps also gives you choice to retire earlier or just have more flexibility to take off time. So when it comes to optimizing your surplus, in terms of that cash flow piece, we say that the surplus is your engine room of wealth creation, i.e., if you don't have surplus funds, it's pretty hard to create wealth. And some of the ways that we reduce that surplus is by frittering away, for Kiwis, sometimes up to 15% of your household income. And a mortgage is a really big part sometimes of that fritter, having the incorrect mortgage structure that's really not tailored to you. We could see some of your hard-earned money just walking out the door. And obviously your mortgage is quite a large part of your expenses and your cost. So is it time for a review? And are there better ways to be able to structure your mortgage in a way that you're not going to have to go and earn more money, as an example, or save more? Another way that we can reduce fritter is looking at our utilities. Sometimes we can get an instant win just by reviewing and going out and comparing our power bill, or it could be any other ongoing subscription that actually is coming out of your bank account. One thing to look at is what is the margin that you're paying on your insurances, as an example, both your personal risk insurances and your fire and general insurances. You could be paying an additional 5 to 10% on top of your premiums for the convenience of paying monthly. A big one that we hit on with a lot of our clients is those extra trips to the supermarket for the top ups, the bread and milk, etc., that we don't add into that weekly shopping budget. And quite often we pick that up through the tracking process. Um, that can make quite a big impact because you're doing it quite regularly. So anything that you're doing weekly adds up very quickly over the course of a year. So if we can nip that in the bud and be a little bit more purposeful in terms of our food spend, which might include something like a meal plan, as an example, then that can very quickly turn into savings over time. I mean, I've had clients who have saved 7,000, 8,000 a year just on being a bit more focused around the extra food spend. Um, Takeaways, I'm not saying you should not have takeaways, definitely not saying that you shouldn't have that coffee. It's if you're doing the 3 coffees a day, sometimes it's easy to be able to cut down on that and achieve, a few extra dollars per week that can go towards that additional surplus. And you would be surprised actually at how those little amounts save up over time. And what we're wanting here is to see the progress, not necessarily that it's just $1 a week, but those snowball into bigger things that end up assisting us, and once we've got some progress going, we start getting a little bit of confidence, we've flexed that muscle memory, then we're cooking with gas. So let's put some numbers around this in terms of if we are taking out a 30-year loan based on that 550,000, a rate of 499 on a 30-year mortgage, that's 510,965 in interest. Gosh, that's a lot of money, isn't it? So if we were to flip that and pay it off in 10 years, we could save ourselves 362,000 in interest, which is massive, right? What could you do with that? And how do we do it? Because there's lots of options out there, and this can be a bit of a minefield. There's billions of dollars worth of mortgages coming off their fix very shortly. So we could be looking at locking in a really good rate. We could look at other providers in terms of refinancing, or we could look at restructuring just within our own provider as well. And look, we also have a way that we work with the mortgage structure at Enable Me in terms of utilizing any savings that are sitting in a separate bucket to your mortgage and then offsetting them against your mortgage with either a revolving credit or offsite type service. We essentially snip off, a part of your mortgage, which let's say it's 20,000, and we pay that down with your savings, and we keep rinsing and repeating that every year with the surplus income that you generate. Really effective way to pay down your mortgage, which also pays it down much quicker and saves you a whole heap of interest. So again, why are we accelerating the mortgage repayment process? We want our clients to be mortgage-free before retirement, ideally at least 10 years before retirement. So we've then got the ability to save towards retirement. Yeah, we want to give us our space to be able to do that, and also to be able to then have sufficient time horizon that if we choose to leverage, we've then got the ability to do that. And, obviously, it's not ideal to have a $550,000 mortgage turn into $1 million mortgage. So, leveraging your equity to build wealth, what does it look like? This is a really simple example to use, and it just compares investing your cash versus utilizing your cash to leverage into an investment property. So here we've used 160,000. If you were to put that into a managed fund at a net rate of 6%, you'd get a return of 9,600. If you were to take that same 160, put it into a property and purchase a property worth 800,000, you then amplify the return on your money up to 48,000. So this is a really great strategy to get you ahead sooner. And look, what I'd say to you is wealth creation is not just for the rich, it's for everyone. So this is one way to help you get ahead sooner. So when I think about wealth also, I think about just giving ourselves options, giving ourselves choice. And we turn that into the choice and options that are right for us. So whether it's giving you peace of mind, knowing that you've got a bit of a backstop, whether you want to line up retiring sooner, or perhaps you want to go, from working full time to part time. Maybe you want to give yourself space to change careers. Maybe you want to give yourself more time to follow passions, or side hustles, or just anything else that you need time for. Um, a lot of people want a little bit more security, particularly after going through COVID and understanding that these things can happen on a global scale. And a lot of people just want to be in a position to be able to help out their kids, because it's really hard to, for your kids to get onto the property ladder. It's really hard to, um, spend time and money on education to get yourself ahead. So it's good to be able to be in a position to be able to support your kids and give them a bit of a leg up. And also, we don't know what's happening in our future and whether our health is going to remain stable, if something's going to happen and take us out of that working career pool earlier than we expected. Or maybe you're just super ambitious and actually you do want to create wealth sooner. Love the saying, get accountability. Whether that's accountability via a plan, a friend, a family member, or someone professional. A coach is someone who tells you what you don't want to hear, who has you see what you don't want to see, so you can be who you've always known you could be. So my key takeaways today are one that's actually not on the slide, which is we can give you strategy, but that's only 20% of the equation. Actually, in terms of success, it's 80% behavior and taking action. So, absolutely track what you spend, channel your cash surplus into your mortgage. Two, structure your mortgage better to optimize it. If you don't know how to do that, absolutely recommend that you talk with a professional and use your equity to build wealth and unlock future opportunities, choices, and options. And for come and see us, we'd love to see you for a check in on your financial situation. So here's our team. We are nationwide. You don't need to come into the office to see us. You can organise a video consultation. We'd love to see you. And the special offer that we've got today is for a first consultation. It's 90 minutes. It's value packed. We're going to go through your money. We're going to understand your starting position. We're going to understand what your goals and your visions are and how we can align a really juicy strategy to get you there. And then we're going to understand what your day-to-day cash flow is like and give you a really great recommendation and takeaway. So this offer, because our sessions are usually $400, is good until this Sunday, the 2nd of November. So you can just scan that QR code there, or you can go to that link enable.me/mortgage strategies. So now we've got a couple of minutes for Q&A. Amelia, hit me with some questions.
Thanks, Kirsty. There have been some great questions submitted. The first question we had was, any advice on how to reduce the stress around mortgage repayment?
Yeah, this is such a common one, isn't it? We had the statistic around that. So I would say identify the problem first and foremost. And sometimes you need a little bit of help to identify the problem. But the first step to that is actually going through your cash flow, essentially, and make that as easy as you possibly can. So I'd say to most people, just use a tracking application. We've got an amazing one. It's called MoneyFit, and that will basically draw out any inefficiencies and show you where the money's going. So you can then identify what your surplus is and then reverse engineer to be able to throw that back onto the mortgage. Because a big part of that mortgage is around not having any wiggle room. So we want to be able to, by way of using our surplus, create resilience and create a buffer whilst at the same time creating progress on paying down our mortgage. So that might not make a whole lot of sense at the moment, but it will always come back to having a really super duper mortgage structure in place that is really going to optimize your money. But it has to be for your personal situation because this is not something that we can do generally. We don't know what's coming up for you in the next 12 months, and we need the right mortgage structure in place that's really going to fit into your personal situation. And I just feel like once you throw everything on the table with your mortgage, then a lot of that stress starts to dissipate really quick when you can talk that out with an independent third party.
Thanks, Kirsty. We're running short on time, so let's just do one more question. This is a very common one. What is the difference between a revolving credit facility and an offset mortgage? Which one works better if you want to pay off your mortgage quicker?
This is such a great question. We get asked this all the time. In fact, we just talked about this morning. So it's always a depends answer to this question because it depends on your personality type. I would say at a squeeze that a revolving credit can be a smidge more effective. And that's only because, no, that is dependent on if you can be super disciplined around it and if you've got really good structures around it, and also may not work for you if you're a big shopper or a big spender, because a revolving credit works like a big overdraft on a current account, which is essentially a transactional account. So what happens is your income comes in, reduces the balance, and then your expenses go out and it increases the balance back up. So you're only getting charged interest on the balance outstanding. It is a floating rate, but if you structure it correctly to take into account what you have in surplus over the course of a year, then essentially you can effectively and efficiently pay down your mortgage sooner using that facility. An offset is a little bit different. It's not transactional in nature. It is still a floating rate, but what happens is it sits separately and it offsets your savings accounts. Sometimes with some banks, it can offset just one account. In the case of some places like BNZ, they have a total money which offsets several accounts. And so essentially, if your savings account is got 20,000 sitting in it and you've got a mortgage that's 10,000, then you won't be paying interest on the balance, which is that $10,000 amount. The difference, generally speaking, is that most offsets are principal and interest. They reduce by that amount, whereas generally most revolving credits are interest only. You can get reducing ones as well. But the offset is not transactional in nature, so not a current account. Hope that answers the question for you.
Thanks, Kirsty. Sorry we can't get to everyone's questions, but if you have any questions about what we do, our contact information is on our website. So we encourage anyone who wants to contact us to find out information there and get in touch. Um, we'll also be sending out a recording of this webinar later today. And I'll let you wrap up, Kirsty.
Thanks, Amelia. So it's been short and snappy today. I know there's a lot of people out there hurting, wondering where their money has gone to. Absolutely encourage you to get in touch with us and take us up on that offer. Usually it only lasts for 12 hours, but we've extended it through to Sunday. So hit us up, come and see me or one of my amazing crew. We look forward to sitting down with you for 90 minutes and hashing out, the steps to your financial success. Have a good afternoon.